All right, let's get right into it. If you're chasing that elusive A-star in IGCSE Accounting 0452, you're in exactly the right place. I'm your subject specialist, and sitting right here with me is our senior examiner, ready to drop some ultimate insider feedback.
Oh, absolutely. We're moving way beyond basic bookkeeping today, folks. We're going to deconstruct the exact syllabus requirements, some really advanced methodologies, and those examiner secrets that literally separate the top tier of students from the rest of the pack.
Buckle up, because we are packing a massive amount of high-yield academic strategy into this explainer on purchases ledger control accounts. So, here's our game plan for today. First up, core accounting architecture. Then, technical execution and methodology. Third, we'll dive into AO3 interpretation and evaluation. And finally, the best part, examiner's secrets and strategy. Let's do this. Kicking things off with Section 1, Core Accounting Architecture. Look, control accounts? They're not just busy work. Think of them as the essential bridge between your basic data entry and high-level financial intelligence. I mean, this is the exact logic powering modern AI-driven platforms like Xero. But to operate at that level, your foundation has got to be absolutely flawless. And that starts with the mandatory Syllabus 2028-2030 updates. You absolutely must now use the term irrecoverable debts instead of the old bad debts, and owner's equity instead of capital in specific context.
Hit the nail on the head. As an examiner, I can tell you right now, 100% accuracy with this terminology, it's non-negotiable for top marks. If you're dropping obsolete vocabulary, you're immediately signaling to us that your knowledge is outdated, and yes, you will be heavily penalized for it.
Right, so let's look at a massive underlying tension in accounting theory. It's basically a tug of war between the historical cost principle and the prudence concept. Historical cost says, hey, record an asset at its original purchase price. It keeps things objective, highly verifiable.
True, but here's exactly where students frequently drop marks. Prudence demands that we never overstate assets or profits, ever. If you've got a sudden, permanent drop in inventory value, and you ignore it just to stubbornly stick to historical cost, you're directly violating prudence. You fatally overstate those profits. This tension, this debate right here, this is the exact analytical depth Cambridge wants to see from you in your longer written answers.
Okay, as your subject specialist, I need you to completely master these 4 critical terms: accrued, prepaid, realization, and consistency. And listen, it's not enough to just memorize a bunch of flashcards. You've got to seamlessly apply these concepts to really complex, multi-layered business scenarios, especially when you hit paper 2. Whether a business pays its rent in advance or when a product is finally sold and the revenue is officially realized, demonstrating true academic fluency with this vocabulary is going to elevate your grade tremendously. Moving right along to Section 2, Technical Execution and Methodology. I want you to think of the double entry system as the structural engineering of a business. If the math doesn't balance, the entire building literally collapses. Every single transaction starts with a source document, right? An invoice, a credit note, maybe a bank statement. That document is your definitive proof. From there, it flows into the books of prime entry, basically the daily diary of the business. And finally, it arrives at the absolute gold standard, the T-account structure. If you memorize this exact, unbreakable procedural flow, you'll never freeze up when an exam question asks you to trace some convoluted transaction back to its origin. Now, zooming in on that T-account, we really need to clear up a vital distinction. This catches out thousands of students every single year. It's the difference between balance BD, brought down, and balance CD, carried down. The carry down balance is your closing plug figure at the very end of the current month. But the brought down balance, that's the opening figure for the next month. Flipping these around or just sticking them on the wrong side of the ledger will completely derail your entire trial balance phase. Get this right, though, and your transition into those final financial statements will be perfectly seamless. Okay, listen up, because here is your ultimate safety net, straight from the examiner's desk. The method mark strategy. You have to always show your logical flow. In the IGCSE exams, we are explicitly instructed to award method marks even if your final mathematical balance is totally wrong. Let's say you miscalculate a single addition right at the start, right? But then you carry that wrong number through the correct double entry process. If your workings are visible on the page, you salvage almost all the marks. But if you hide your workings, a tiny calculator slip turns into an absolute 0. Speaking of calculator slips, let's dodge some major mathematical pitfalls. The biggest culprit? Miscalculating discount percentages. You absolutely must calculate the trade discount before you calculate the cash discount. Reversing that order is just a fatal trap.
Oh, for sure. And additionally, please do not forget your state symbols or your currency signs, especially when you're working through those comprehensive manufacturing accounts. These little micro errors, they instantly signal carelessness to the examiner, and they just chip away at your final score.
All right, jumping straight into Section 3, AO3, Interpretation and Evaluation. Calculating the numbers correctly is just the baseline. Honestly, it just gets you a B or a C. Interpreting what those numbers actually mean out in the real world is what defines an A-star response. Just think about a severe drop in a current ratio, say 2.5 to 1, plunging all the way down to 1.1 to 1. A business that used to have $2.50 of liquid assets for every single dollar of short-term debt is now barely scraping by. If one unexpected bill shows up, this business might default. The sheer gravity of that liquidity crisis is exactly what you need to recognize and highlight. Exactly. But why did it drop? That's the real A question you've got to investigate. Has the business overpurchased inventory that's now just sitting there completely obsolete in some warehouse? Are trade payables being settled way too slowly, which is damaging essential supplier relationships? Or, hey, were cash reserves completely wiped out by a massive capital expenditure, like buying brand new machinery? You have to build this exact cause and effect chain in your exam answers to unlock those top-tier marks in AO3. In evaluating this, gets even trickier when you're comparing two different businesses. Why? Because differing accounting policies completely complicate interfirm comparisons. Like one business might use the straight-line method for depreciation, giving them nice, steady, predictable expenses.
Right, and on paper, that first business looks highly profitable right out of the gate. But wait, a competitor might use the reducing balance method, which means they're taking a massive expense hit in year one. So that initial profitability of the straight-line business, it's often just an illusion created by their accounting policy, not actual superior performance. You have to play detective and investigate beyond the surface numbers to uncover the truth.
Which brings us to our final part, Section 4, Examiner Secrets and Strategy. Welcome to the Insider Vault. This is where we share unfiltered feedback directly from recent principal grading cycles. And I need to issue a really stark warning right now about a painfully simple error. In our recent principal examiner reports, we actually wrote, students often lose marks through poor handwriting in ledger accounts. Guys, it is an absolute tragedy to master complex double entry accounting only to lose the grade because your 5 looks exactly like an S or your balance CD is functionally illegible. I'm telling you, if I cannot confidently read your ledger entries, I cannot award you the marks, period. Let's quickly run through our definitive exam checklist. The most frequent and honestly most costly conceptual failure is mixing up revenue expenditure and capital expenditure. If you buy a delivery van, that is capital expenditure. Boom, it goes straight to the statement of financial position.
Spot on. But if you pay for the petrol to run that van, that is revenue expenditure, and it goes to the income statement. Mix those two things up, and both of your final financial statements are going to be entirely wrong.
And of course, meticulously manage your time based on the weightage of the question parts. Please do not spend 20 minutes agonizing over a basic 3-mark calculation. Okay, when exam stress hits and that panic starts setting in, you need a mental hook. We call this the anchor. Assets equals liabilities plus equity. It's the whole shebang, the fundamental accounting equation. If you get stuck on a highly complex control account adjustment, just stop, take a breath, and ask yourself, how does this affect my assets, my liabilities, or my equity?
It's basically magic. If you ensure this equation remains perfectly balanced after every single adjustment you make, your underlying math is going to be absolutely bulletproof. Rely on this memory hack when the pressure is really on.
To wrap up this explainer, we want to leave you with an A-star challenge question. I want you to look way beyond the pure math, pause, and really think. How do non-financial factors, things like staff morale, physical location, or market reputation, impact the true quality of the profit you just calculated?
Seriously, a business might show a spectacular return on capital employed this year, but if staff morale is totally toxic, is that profit actually sustainable in the long term? Keep pushing your analysis further, folks. Master these concepts, trust your methodology, and that A-star is well within your reach.
Absolutely. Thanks for joining us for this masterclass. See you next time.